the really big question for 2022 really is, how big of a backbone does Jerome Powell have, right? Which is essentially what you're saying, where it's really going to come down to central policy at this point in time, which is how much pain are they going to be able to stomach in terms of raising rates here and the impact of bringing demand down. You've referenced the 70s. I want to get to that a little bit more in just a minute. But I agree, it sounds like we could maybe have something similar there, where we had several Fed chairs before Volcker came in with the mandate to break inflation. I think a lot of people kind of forget that, there were several predecessors of his that were trying to fight inflation, but they just couldn't stomach bringing the rate up as high as it ultimately took to bring it under control. So do you see something similar here, where we're kind of, Powell and maybe whoever comes after him are going to be, trying to talk tough, but maybe not really have the cojones to do what it's really going to need to be done to tame inflation? So we're going to have persisting inflation and this economic malaise and kind of be in the sort of chop range that you were just talking about?
I think so. And in some ways, it's worse than that, because in the 70s, you had very low debt levels. And so at the end of the day, Volcker could raise rates to very high real levels. And it caused a recession, but it didn't cause like a financial crisis, a depression, because you had pretty low debts in the system. So the economy could withstand those higher rates with a slowdown. And before Volcker passed, he even said he couldn't do that today. And it's only gotten worse since then. And so that's one reason I've used the 40s as in many ways a closer comparison than the 70s, because in the 40s, you had very high debt levels due to the war and due to things like that. And so despite the fact that they had high inflation, they just had to hold rates low anyway. And so you had a big decoupling between rates and inflation. And we've already seen that play out so far. And so even though they're talking tough, they're still, rates are still below 1%. And so they're moving up pretty slowly, despite the fact that we have multi-decade high inflation. And I think that's a testament to how much debt is in the system. And so I think we're kind of in an environment where inflation is going to be a persistent issue. They're going to try to talk tough, but at the end of the day, the math, matters, right? So for example, if they cause the credit market to become illiquid, if they cause the treasury market to become illiquid, if they, cause an outright recession, we start to see high employment, that makes it very challenging for them to continue doing what they're doing. And so I think they're kind of stuck between a rock and a hard place, and that the release valve ends up being this weird situation where they're unable to keep tightening despite the fact that inflation is much above their target.
I'm going to put up a chart here that you retweeted of Charlie Biello's recently, which speaks to this massive disconnect between inflation and central bank courage to tighten. And just reading Charlie's tweet here, he says, Eurozone inflation has moved up to 8.1%, its highest level ever. Meanwhile, the ECB is still holding interest rates at negative levels. This is perhaps the greatest disconnect between easy monetary policy and unabating rising prices that the world has ever seen. Now, this chart doesn't look totally different from the situation in the US. We're a little bit better, but not that much better. So to your point, there's so much debt out there. Is this really a testament to the trap that the central banks are in here, that they're just not going to be able to act as tough as they are talking, because they will ignite the powder keg of debt that lays out here if they try to raise rates too much longer?
Yes, I think that's a good way to describe it. And that's, that was summed up by Ray Dalio's long-term debt cycle thesis. And that's something that I've incorporated in my research starting several years ago. And one thing I found is that looking back in history has been able to make some sense of the situation. So it goes back to the old quote, history doesn't repeat, but it does rhyme. And so the history can't tell us what's going to happen. It's not like, okay, here's step 1, 2, 3, and here's step 1, 2, 3. But, a lot of people keep describing this as unprecedented or saying we've never seen something like this, where actually we have. It's the 40s. The last time we had a disconnect this big between rates and inflation in North America and Europe was the 1940s. Because of Ray Dalio's good research and the research of others, and then adding my own research on top of it to kind of look at that thesis, for the past few years, I've been expecting this higher inflation, but not the correspondingly high interest rates, which is what we've seen. It's kind of a specific outlook, and now we're starting to get that kind of that slow rate rise, but it's starting from such a low base, and we're kind of already testing the limits of how high that I think they're going to be able to get. And so I think that pretty much sums it up, that they've encouraged so much credit growth for decades that they have a massively high level of debt to GDP, and that's true in the United States, in Europe, in Japan, and elsewhere, super high debt levels. And then therefore, when we finally have a true inflationary impulse, basically lack of commodities, supply chain problems, and a lot of money creation, they're unable to raise rates to try to tame in that inflation, or at least to the degree that they need to.
All right, I'm going to ask a couple rapid fire questions here. One is, you said the Fed and the other central banks, they don't have a great track record of soft landings, right? So what do you think the odds of them getting away with this are, right? In other words, is there really a chance that they can kind of somehow thread the needle and come out of this gracefully? Or is the best case scenario here that we are just living with persistent higher inflation than we've been living with for the past couple of decades?
I think there are very few ways for them to have a soft landing here. I think Luke Gromen described it best, that basically outside of some sort of massive unexpected productivity increase
Right.
that happening, it's really hard to see a way out, right? Because basically, in order to have real growth, meaning inflation adjusted growth, we'd have to bring more energy online.
Right. And I'm sorry to interrupt, but in your answer, I want you to address this. So you've mentioned the 40s a couple of times, but coming out of the war period in the 40s, one, we had the enviable position of being the best economy, ready to help meet all the rebuilding demand growth and stuff like that. But we also had cheap hydrocarbons coming online there that gave us a multi-decade tailwind. We don't have that now.
Yeah, so in the 40s, a lot of that spending could be turned off, right? It wasn't kind of based on aging demographics and things like that, right? So we could do some degree of austerity after the war, as well as rebuilding. And as you pointed out, we had abundant natural resources. We were not really kind of tapped into heavily the whole kind of world reserve. At this current time, we don't really have new supply coming online anytime soon, at least any sort of significant new supply. And so, if you're asking me this question in the 2030s, maybe eventually we've kind of gotten through some degree of pain and we're building up from there, right? So maybe by that point, that'd be part of discussion. But I think as we sit here in the 2020s, it's more like the early 1940s, right? There's still a lot of stuff ahead. Now, hopefully not the same type of stuff as the 1940s, but in terms of fiscal and monetary policy and different entities fighting over resources, essentially. Hopefully not very kinetic, but we're already seeing some kinetic actions, but hopefully not a lot of kinetic. But I think that we're still early in that process, where it's kind of premature to talk about soft landings. Now, in the cyclical sense, right now they're trying to decelerate the economy. And the question is, can they kind of take the edge off and then stop tightening for a little while and then go back to kind of normal stagflation, perhaps, if they're forward looking. But I think that the idea that we're going to get to stable prices and positive real yields anytime soon, and then maintain those for quite a while, I think that's the part that's far-fetched, right? So we can always have these moments of, disinflationary issues, and you briefly have positive real yields in terms of, say, actual inflation compared to, say, treasury yields. But I think that the ability to normalize anytime soon is pretty much off the radar.
All right. So then this is where it gets interesting then. So, thinking back to that chart that I just showed of Charlie Bielo's, let's say the Fed does a couple more rate hikes and then it pauses or pivots, but let's even just assume they pause, right? Sort of two questions here. I imagine if they do, I know that at least Bill Fleckenstein thinks that that's the moment where the Fed is going to truly lose the bond market, where the bond market's going to say, you know what, guys, there's no way you can get inflation under control, and you've just proven it, right? And therefore, the bond market's going to really start taking, longer duration yields up even higher. So is there a chance that this could get away from the Fed, that they're trying to engineer the soft landing, but they either slow the market, the economy too fast in the process, or it's just so anemic that it can't handle even the slightly higher debt levels? And then, of course, if the bond vigilantes begin taking yields even higher, could that start a cascade that really takes this process away from the Fed?
So I think so, but then it comes down to a Fed decision, right? So, for example, that's kind of the end game for this particular long-term debt cycle is the Fed having to capitulate on tightening despite the fact that inflation is still high. And that's been my thesis for a while, that they're going to get to that point. The question is, what do they do then? The Fed can always choose to override the bond market with formal yield curve control, right? And this is something I've been eventually anticipating. We've seen it in Japan first, where the Bank of Japan just comes out and says, I know you want to price bond yields higher, but we're not going to let you. We're just going to do an unlimited bid with printed money to peg yields at what we want to do. So the Federal Reserve can come out and say, I know you want to raise yields, but we're just not going to let that happen. We're not going to let the 10-year go above 3%, for example. And the offset would be massive currency devaluation, right? So there's
Right,
no
that's where
free
I was going to
lunch.
go. Exactly.
Yeah,
Yeah.
there's no free lunch. And so if they control yields, they get massive currency devaluation, which is basically massive inflation. And if they don't control yields, then they have basically a fiscal spiral. You have something like what, say, Europe experienced in 2012, until the ECB stepped in and basically said, we're going to hold this together. So you'd have basically rising yields in the U.S. and elsewhere, and you'd have budget deficits blow out, and then there'd be no clear way for them to recover that, right? Once debt as a percentage of GDP is that high and deficits are still widening, that's a disaster for the solvency.
Right.
And so I think at the end of the day, they're gonna let the currency go and control yields, because I think it's kind of the only way out. But of course, that's disastrous for cash and bondholders. But I think that there's a bumpy road between then and there, because that's basically a complete capitulation, right? That's kind of the end of central bank credibility.
Right.
To kind of to whatever. There's still some left in the sense that the market, they seem to fully believe kind of Fed tightening. They were, if you look at, say, oil futures, right? So priced out several years, 2025, 2026, they're much lower than current oil prices. The market still is kind of looking at this as rather transitory, that we're going to normalize this, that it's war related, even though it was all happening prior to the war. And so I think that the market still has that degree of credibility for the Fed. And it's not until that they have to stop tightening at some point. They run into one of the breaking points I mentioned: credit markets, treasury market liquidity, recession, something like that, with inflation still being a problem. And when they kind of fold, I think that, yeah, that's when you kind of have that game changes. And I think probably currency devaluation is the most likely outcome.
Right. Okay. And of course, that's what we're seeing in Japan right now, which
Yeah.
is doing yield curve control, and we're seeing the yen depreciate substantially versus other currencies.